Hello and welcome to NDTV Profit. You're watching the Portfolio Manager, and my guest today is Ashish Chaturmohta, who is the Executive Director and PMS Fund Manager at JMFL. Ashish, thank you very much for joining us on the Portfolio Manager. The indices are at all-time high. I wanted to check with you because your portfolio largely comprises of large cap stocks. How are you managing the stocks and the portfolio at this point in time?
Hi, good afternoon, Sajid, and thanks for calling me on this show. To give you a perspective, this strategy, what we call is our XPMS strategy, is basically we follow the concept of the FTPM approach, which is nothing but a combination of fundamentals, technicals, market dynamics, and psychology. We believe these are four important pillars, and considering this style of investing, this is a flexi cap strategy where at all point of time we have minimum 60% allocation which goes to NSE 200 names. So basically at all point of time we will see top 200 names having a weight of almost 60% bare minimum, which can increase to a higher side in case if we find some serious risk coming into the small and mid cap basket. And in a comfortable zone, when we find small mid cap in a comfortable zone, we try to be around 40% of our allocation into small and mid cap basket. So this is how the portfolio is positioned. But more importantly, where we differentiate ourselves is in the approach where we call that 60% of our allocation of the overall portfolio is buy and hold in approach, where the intent is to ride this longer term structural themes which are more aligned to the growth in GDP, which are more aligned to the sector's strength. And if we find that the sector is going to grow beyond the GDP numbers, then obviously if there are market leaders within those sectors, they are going to outperform significantly. But in the 40% allocation, what we call as a tactical or opportunistic bet, the intent is not to be really real buy and hold, but more on tactical allocation, which gives us a flexibility to identify some medium term trends which are emanating in the market and try to ride those trends at least in the medium term so that we can maximize the returns.
I guess that's the reason why you have a very good returns for the last 1 year, 37.3% for the last 1 year returns coming in, because especially because of the mid cap and the small cap portfolio that you have been betting on. Ashish?
Yes, you're right. In fact, as you see, the portfolio overall weight perspective, 63 to 65% at this point of time is coming from large cap space, which has actually done nothing in the last 1 year period. Because if you compare, Nifty 50's return versus BSE 500, Nifty 50 has significantly underperformed BSE 500. But in our portfolio, at most of the times, we are holding 50% allocation to Nifty 50. But despite that, we are able to outperform almost 400 basis point to BSE 500. The reason being because the bets which we took on basically on the small and mid cap has done phenomenally well, because in a short span of time, a lot of these stocks gave more than 100, 200% kind of returns. And this really helped us in managing the drawdowns or underperformance which was coming typically from our large cap quality names which are not performing at this point of time, but we believe these are the names which we should be holding from a longer term perspective. So this definitely, this small and mid cap has really helped us. Also, what has helped us in large cap is because we entered on a very timely basis most of these power companies or public sector undertakings. So if you would have observed in our portfolio, we had a good chunk of public sector undertakings, including CPSC ETF or PSU Bank B's ETF as a bet to ride this entire trend which is emanating in the PSU banks as well as the CPSC ETF. And apart from that, we believe that power is one space which is gaining a lot of traction. And as we can see that the renewable energy capacity, which is currently at 178 gigawatt, is going to grow to almost 500 gigawatt in next 7 years, which implies that almost 17% capacity CAGR growth we are going to witness in the space. And a company like NTPC, which is already going to create 30 gigawatt capacity addition in the renewable energy, we believe that this could be very, very positive for most of the power related companies. And as we all know that power is in demand, and the with rapid industrialization, real estate, capex, manufacturing going to grow well. even thermal you can't miss out, and that's how we bought Coal India at an appropriate time. So this has really helped us even in an outperformance which came from large cap names. So stocks like NTPC, Coal India, BPCL, CPSC ETF, and PSU Bank B's ETF were some of the large cap themes, but which really gave us good outperformance in last 6 to 9 months time frame.
Give me a sense of, you're an active fund manager, but I see that in the top 10 holdings, you have at least three ETFs which are there, which is Nippon ETF Nifty IT, then Bank B's, and Nifty Pharma ETF. Uh, what is the rationale of investing in a passive fund when you are an active fund manager?
Yes, so that's why we said that in 40% of our allocation we are very active. So there we don't hesitate to take an active call, even if we have to take that call within a month's time. Also, we will not hesitate to take those active calls. But when we try to identify some larger themes, and we believe that these themes can do really well over a long period of time, we try to play those themes. Even through ETFs. So, for example, this is this PSU Bank B's ETF. I've been recommending since for last 4 years, since 2019-20, when this ETF was quoting at around 2021. Both the public sector bank PSU Bank B's ETF as well as CPSC ETF, which used to quote at 22-23 levels. And today, if you look at these ETFs, these ETFs itself has given almost 4 times return in the last 3 to 4 years journey. The reason why we believe is that sometimes playing ETF makes a lot of sense is in the PSU banking basket. Initially, it was very difficult to take a call beyond stocks like State Bank of India or Bank of Baroda for that matter, because there were a lot of concerns with regards to their asset quality, the kind of NP numbers they were throwing. But one thing was very clear: the way credit growth is going to emanate because of the manufacturing, because of the government capex government is trying to put in. A lot of private players will eventually come and will need a lot of credit, and that's how there is going to be a lot of credit growth momentum. And typically, most of these PSU banks, they try to be more on the corporate credit side rather than on the personal loans, or what you call as a retail loan. And that's why we believe that if this loan growth momentum is going to be 17 to 18% kind of credit growth, NPA numbers is going to come down, because structurally this NPA cycle which we saw in 2011 is going to be behind us, and the stress is coming out of this public sector banks. But we were not sure whether it's going to be tier 2 or tier 3 players who are going to be a bigger leader. So rather than taking a bet on individual names, we thought that it's better to play the theme through a public sector ETF, and it really helped us in this 9 months. Also, I think this ETF must have delivered more than 40% kind of return. Same is the case with public sector CPSC ETF, where you have exposure to power, you have exposure to defense, you have exposure to oil refinery companies, which typically you want to avoid because you don't know when the government will take some stringent measures, and that will lead to margin erosion, or exactly what happened to ONGC at one point of time, where you put in windfall tax gain. But one thing was clear, that because of the governance level which is improving in the public sector space, the price to governance, which we call as, is a very standard metric to judge that if the governance levels increases, you start giving a higher PE multiple. And that's how we realized that rather than betting on individual names, it's safe to bet on a public sector ETF to ride this entire trend which is emanating in the space. Now, coming to IT, we believe that
IT, because IT and pharma both have been very quiet in that sense. We've been seeing headwinds for both the sectors. Pharma has been pretty flat; it's not been giving much return. So, what is the rationale for investing in IT ETF and the pharma ETF?
So yes, so I think if you would have realized that a lot of these large cap pharma companies, they have started gaining some amount of price in the US markets, and there is some amount of pricing power which is coming back. So at one point of time, we were seeing double digit price erosion which was happening, but that has come to low single digit in the last 1 year's time frame. And obviously, if we also try to understand from a technical perspective, you would have observed 2015 is where Nifty Pharma peaked out, and it is almost 7-8 years. After 8 years of consolidation, your pharma index is coming back to the to its previous zone, which clearly indicates that after 7 8 years of consolidation, if the index is coming out of a consolidation phase, there is a very strong possibility that we might see some relative outperformance, which we are going to witness in days to come. And as I said, the price erosion, which was almost in a double digit, is coming to a single low digit. This is also very positive for a lot of these pharma companies, and companies like Sun Pharma, which is doing extremely well on the specialty business in US. I think that is also going to be very positive. So what we realize that rather than betting again on an individual name, and since the sector is coming out of a consolidation phase and you don't know who is going to be the leader in the space, at that point of time, we try to bet initially first on the ETF, and then once we get a better clarity, that's the time we try to take a bet individually. You must have also observed there is one individual bet in the pharma space, that's Granules. So Granules, we were very comfortable on this API player, and that's how we decided to take an individual bet on Granules. And I think in the last 2 3 months itself, the stock has delivered almost 20 22% kind of return, again outperforming the broader pharma index. So you can compare Granules like a mid cap IT, how mid cap IT has been outperforming the broader large cap IT in the last 6 to 9 months frame. That's the same way I think a lot of mid cap pharma companies which are more specialized in a particular segment, they are trying to show some strong relative outperformance compared to the broader pharma basket.
How do you look at ICICI Bank and HDFC Bank? We've seen some kind of headwind on HDFC Bank. Some, the stock also had some setback after the lack of communication coming from the management. How do you look at that? Because these two seems to be the large holding for you in your fund.
I would like to draw your attention here as well. If you look at our top holding, it's ICICI Bank in terms of the allocation in the banking and financial basket. And in fact, it might be looking on a top holding HDFC Bank as a position, but from a relative weight perspective, HDFC Bank, we have a significant underweight position. So if our current weight in HDFC Bank is close to 3%, whereas in the Nifty 200, this weight would be around 9 to 10%. So there's a significant amount of underweight which we are in HDFC Bank. Our returns which is coming basically from the banking basket is coming from ICICI Bank and the public sector PSU Bank, ETF and SBI. So I think these are the three names which are actually contributing to our banking rally. And my sense is ICICI Bank is consistently growing very well. It has managed its NIM expansion and is still quoting a discount to HDFC Bank. So our sense is this ICICI Bank could be a leader in the overall private banking basket, and that's the reason we are significantly overweight in ICICI Bank. But apart from that, it's BSU banks which are actually the significant overweight position in the banking basket.
Ashish, we were talking about the defense stocks before the break. Give me your rationale for some of the defense stocks. We've seen in the last one quarter, basically with respect to the earnings which has come in some of the stocks in the Q3, it's not been as bullish as the order book they have been carrying.
So so I think defense is a very big opportunity. We have to understand that the capital outlay in defense is going to be at 12% CAGR, and I think that this is going to be a 10 lakh crore kind of opportunity. In that, if you look at the Navy itself is going to be almost 3,82,000 crore kind of opportunity size. Guided missiles could be almost a 1 lakh crore kind of opportunity size, and fighter jets or jet could be an opportunity of almost 4 lakh crore. So I think this is a very big opportunity. We have to look into book to bill ratio of most of these companies. So they are at around 5 to 10 times. I'll give you an example. A stock like Bharat Dynamics, which is doing a top line of close to 2,400 crore, are sitting on an order book of almost 24,000 crore. So it gives a book to bill ratio of almost 10 times, and the revenue visibility is very strong. We believe this can lead to a 15 to 20% top line growth for at least next coming few years. And with a lot of indigenization which is taking place in the defense companies, this is resulting into operating margins going upwards. So if you look at one point of time, Bharat Dynamics used to do a 55 to 60% used to be indigenization and rest used to be import. But today, if you look at it, is almost above 90%. It is indigenization. So that is leading to a lot of operating margins upside, and that's the reason almost 20-21% kind of operating margins we are witnessing in a public sector, defense company, and this will result in a PE multiple re-rating happening for lot of these defense companies. Take an example of a company like Cochin Shipyard, where it did hydrogen fuel ferry inauguration a couple of days back. And if you look at it, is also into electric vessels. They are going to come over a period of time. So if you look at in Europe alone, almost 2,500 vessels are going to get into the EV space. And if that happens, then this is a very, very big opportunity size for a company like Cochin Shipyard. Globally speaking, India is having just 1% market share in the shipbuilding space. And if this number starts to improve, then that's a large opportunity size which exists for players like Cochin Shipyard or Garden Ridge or Mazgaon Dock. And that's the reason we believe defense is a big opportunity. It's not like what we have seen in railways, where we have seen a massive rally coming into these companies, but the top line is going to grow only 15 to 20%. So there was a significant amount of PE rating which happened, but earnings flow will take really long period of time to come. So this could be possibly because of low float. These stocks have done reasonably good. But in case of defense, we believe the structural opportunity is very, very large, and that will result into positive action coming into names like Bharat Dynamics, Hindustan Aeronautics Limited, or Cochin Shipyard, to say so.
How do you look at consumption basket? Because at one time it used to be a defensive stock. You're not as bullish at them. Many of them are trading at a very high PE as well. Do you see these stocks continue to trade at a PE despite the fact that they will continue 10-20% growth going on?
Yeah, so that's the reason why we are seeing a significant amount of relative underperformance coming from a large cap, FMCG companies, or even consumption names, except for names like Titan, or Senko or Trend, which are actually showing some serious same store sales growth. Or a company like Trend, Titan or Senko, where we are seeing some significant amount of volume growth coming into play. But if you look at most of the QSR players or FMCG companies, they are not seeing very strong trend at this point of time, because either the rural consumption is at a back foot, or we are seeing some significant amount of manufacturing growth, but and the multiples are still far lesser. Obviously these are more cyclical, but at this point of time, what markets are going to reward is the earning growth, and that earning growth part is missing in most of these FMCG companies or consumption companies, whereas the multiples are at significantly higher level. And that's the reason we believe this consolidation can continue for consumption companies. But yes, exceptionally, we believe companies like Titan, Trent, or for that matter, companies like Senko, or in the QSR theme, we think a company like Vector Food, which is a proxy to the QSR theme, can be a good play. But in general, we believe that this theme is going to enter is into a consolidation phase, and it will take reasonable amount of time for them to show some strong earning growth momentum.
Final question to you, and quickly, because you have nearly 40% of portfolio in mid cap and small cap, and we've been seeing a lot of regulatory action coming for the mutual fund industry because of the kind of flows that are coming into this. What is your way of looking at your portfolio, where you have a significant amount in small and mid cap, in terms of stress testing of your portfolio?
So we have done our stress testing, and we have seen that most of the stocks which we are holding have a very good liquidity, strong earning growth momentum is there. And we also did one more test, that what is the percentage allocation which is there into stocks beyond BSE 500. And that's where we find it very comfortable that we don't have a significant amount of allocation into stocks beyond BSE 500. And I think stocks between 200 to 500, which are part of the small and mid cap, have a very high liquidity, strong capital base, I think, and with strong earning growth, and with a lot of large MFs holding these positions. At least we are comfortable holding those kind of names. But yes, maybe 5 to 10% of the portfolio could be aligned into stocks beyond BSE 500. So there we are always prepared. And as I said, this is the FTPM approach where we will take a call if we see some serious trend reversals coming into some of these names. So we will not hesitate to cut our positions in case if we find some dent. But at this point of time, we are very comfortable with most of the stocks we are holding in our portfolio.
All right, Ashish, it was a pleasure talking to you today. Thank you very much for joining us. That was Ashish Chaturmohta, who is the PMS Fund Manager at JMFL, and you're watching the Portfolio Manager. Thank you for watching today.